Hey dividend investors, today I am going to talk to you about the difference between an ETF, an exchange traded fund, and a mutual fund. The differences between them, but also the reason why I will never, ever buy another mutual fund. Let's get down and let's check this out. What we're going to be really talking about today and comparing is two BMO ETFs with a TD mutual fund. A TD mutual fund that I know very well because I invested in it for about a year. So let's check out what a mutual fund is really versus an ETF. So mutual funds can be and are traded on the stock market. For example, this TD mutual fund is TDB 972. It is a dividend growth fund. If you can tell by the title of this channel, love dividends. I don't like mutual funds anymore. This is why. So MERs, this is how much they take from you to manage your money every single year. And that's 2.03% in this fund. Now, the reason why you would want to pay a higher MER is for higher returns. You would expect that the more money that you get back from them is worth paying them more money. And I'm going to tell you today that it's not necessarily that fact. Now, from there, nowhere on the internet you can find what percentage you get paid from this dividend growth fund. But from somebody, myself, who has invested in this for just almost about a year up until in the middle of the summer where I sold out of it, basically it's about 2.5% dividend from that 2% MER essentially. So essentially what you're really getting paid is 0.5, or at least how I look at it, is 0.5% dividend because they take that much from you. Another amazingly bad thing about mutual funds is their early redemption fees. So most mutual funds will give you 7 days that you are unable to sell the mutual fund. And if you do sell it, it's going to cost you 2% of what you invested. So for example, if you invested $1,000 into this mutual fund and you said, well, the stock market's turned for the worst, I'm going to just get out before it gets too bad, or whatever it may be, or hey, I got another investment idea, this has gone up a good amount of money, whatever it may be, you have to pay 2% of your whatever you invested. So for me, it was like $15,000 or something like that. And I didn't pull it out early. I stayed in for about a year. But if I was to pull out, let's say 6 days into it, off of $15,000, I would have to pay about $300 of a penalty to sell, which is ridiculous. They're not just getting you on the MER, they're getting you on early redemption fees. This is why I personally highly dislike mutual funds. Another issue that I have with mutual funds, and now this may not be the same with every single one, but with TD mutual funds, you put through the sale, like you say, hey, I want to sell it today. You can't say at what price you want to sell it, but you just have to say, hey, I want to sell my mutual fund. And then it's going to take until the end of the day for them to calculate the numbers. And then basically you're getting the sale on the end of the day that you put through the sale and the closing number. And that's how it was explained to me. However, I did the math, and from the time that I sold it to the time that it actually sold was about 3 days. It took 4 days to show up in my account, and it's a trading account through TD. And it took 4 days for 3 days to actually sell, and then 4 days to show up as money in my account for me to finally start trading on other things. So I'm not too sure if this is the same with every single mutual fund or just TD mutual funds or whatever it may be, but that is my experience with trading mutual funds, at least on the stock market level, which is a pain, let's face it. You have to sell, and then you're told by bank managers and by people who, when you phone them up on the phone, they're like, hey, yeah, it's going to be going through the end of the day, it'll show up tomorrow, and it doesn't show up for 4 days. There's some issues there, and I was unlucky enough because the stock market was just taking a bit of a slide at that time. And I actually calculated that if they were to sell at the end of the day that I said to sell, I would have actually ended up with about $500 more. So that's another thing that kind of ticked me off. But let's get down and let's check out the differences with an ETF now. But really quickly, the top 10 holdings of this mutual fund is a lot of banks because it is a dividend mutual fund, but also a lot of oil and railway stocks as well. Now, this is a BMO income ETF that is kind of similar in a way. It's got the same risk profile, but when it comes to the chart, it hasn't really moved, let's face it. But the mutual fund moved slightly higher, so that's not too bad. You are getting, in this case, a little bit more growth when it comes to the chart, as we can see here. However, this chart is including dividends from what I have seen when it comes from roughly here where I bought in to about roughly here where I sold. It is showing to me that this chart is also showing dividends. While this chart here is not showing dividends, it's showing your actual underlying equity improving. But from there, you are getting with this one, which is a fairly level and even risk profile, you're getting a better yield. You're getting 4.3%, which is roughly 1.7 or 2% higher than what you would get in that mutual fund. You're also looking at the MER, the cost, because of course ETFs do have an MER, and the MER here is 0.55. That is essentially a 2% difference right there. That's huge. So if you are improving the stocks in the mutual fund versus the ETF go up by, let's say, 2%, then in this ETF, you're actually making money, while in the mutual fund, you're not. And an ETF that I really like, it's got a little bit riskier of a profile than the other accounts that I mentioned, the ETF and the mutual fund, but BMO Covered Call US Bank is extremely good. It currently has an MER of 0.65%, so just a bit higher than the ETF, but a heck of a lot lower than that mutual fund. And the dividend on this is insane at 8.5%. You can make so much more money from this ETF. However, this ETF is a bit more risky. It is US banks and it is a covered call strategy. If you don't know what a covered call strategy is, basically you're holding, let's say the account, the ETF is holding stocks and it's selling call options against it. If you don't know what that is, totally fine. I've got videos on my channel that explain that. This downfall, everything happened with COVID, and now it's recovering nicely. I bought into this one right about there, which is fantastic, and I've again have gained from this ETF. So that's my experiences when it comes to ETFs versus mutual funds. The main difference is ETFs, you don't have to hold for 7 days to sell. You can literally buy it one day, sell the next, and you're not going to get penalized for it 99% of the time. That 1% is some of the higher level ETFs that you may need to invest a minimum of $100,000, because there is a few out there that are like that. They're more for the elites though, so you're not going to have to worry about it in most cases. And if you have to worry about that, then congratulations, you have a lot of money. But from there, I hope that this video has helped you understand the differences between an ETF and a mutual fund. A mutual fund is going to take more money from you, while an ETF doesn't. I hope that you've enjoyed. If you have, hit that like button, subscribe, and I'll see you guys again next time.